Musing on Markets. This is a blog post by Professor Damodaran. He is interested and doing many articles on valuations, on general economy status, and he goes to the details in the numbers, and he has in general very detailed view, very based on both stories. Which story do the economy tell us? Because you can say, I just look at the numbers, but no, this is not enough. You should combine the numbers with reality, and then there is a whole story of valuation. Okay, so Musing on Markets, my not so profound thoughts on valuation, corporate finance, and the news of the day. From July 17, 2023. Market resilience or investors in denial? A mid-year assessment for 2023. So I think the background for this is that first, we didn't see a crash yet, at least in mid-year 2023, and we even started seeing an increase in the stock market, which shows that it's in some kind of resilience. So I'm not a market prognosticator for a simple reason. I'm just not good at it. And the first 6 months of 2023 interest rate market timing is often a possible dream. Something that every investor aspires to be successful at. So yes, he makes good claims here. The first is saying, yeah, I cannot look into the future. Yeah. But very few succeed on a consistent basis. At the start of the year, the consensus of market experts was that this would be a difficult year for markets, given the macro worries about inflation and an impending recession. And adding in the fear of the Fed raising rates, to this mix made bullishness a rare commodity on Wall Street markets. Markets, as in there, won't live to surprise, and the first 6 months of 2023 has wrong-footed the experts again. It's amazing. I find this quite amazing how every time the experts are predicting something and it's just not happening. Okay, they predict there will be crash, there is no crash. They predict there will be something else. Every time it's always something else, totally else is happening. Okay, you cannot believe anyone. Basically, we cannot believe anyone. Okay, so the start of the year blues leading into 2023 as we enjoy the moment with markets buoyant and economists assuring us that the worst is behind us, both in terms, again, they are telling us something. Yeah, I don't believe you. Them, okay, Damodaran is really have foot in the ground, both in terms of inflation and the economy. It is worth recalling that the conventional wisdom was coming into 2023. After a bruising year for every asset class, with the riskiest segment in each asset class being damaged the most, there were fears that inflation would not just stay high, but go higher, and that the economy would go into a tailspin. While this may seem perverse, the first step in understanding and assessing where we are in markets now is to go back and examine where things stood then. In my second data update post from the start of this year, I looked at the US equities in 2022 with the SP 500 down almost to 20%. In 2023, we did have a downturn. During the year, and the Nasdaq overweighted in technology, feeling even more pain. Down about a third during the year. Okay, so we have here this chart. Yeah, and we see here it's beginning in 2021. And in January it's going down, started from 100, almost 70% down. Wow, this was good. It's still down from the 100%, where it's still like at 80. Here, yeah. So SP 500 is the blue line. Yeah, SP 500 minus 20%, Nasdaq minus 30%. We are still doing good. We're still having an opportunity here. The persistent one who work for a living, make a living, and invest every month in the stock market and spreads his investments is the best one. This is the way to go. Looking across company groupings, returns on stocks, and also I have to add another thing. If you're trying to optimize for the best expense ratio, the 10 years can pass and you are trying to find the best account to invest in, the best tax efficient, and after 10 years have passed, I mean, just start with it as young as you are. Looking across company groupings, return on stocks in 2022 flipped the script on the market performance over much of the prior decade, with the winners from that decade, tech, young companies, growth companies, singled out for the worst punishment during the year. While stocks had a bad year, the eighth worst year in the last century. The bond market had an even worse one. In my third post at the start of 2022, I looked at the US Treasuries, the long-touted haven of safety of the investors. In 2022, they were in the eye of the storm, with the 10-year US Treasury bond depreciating in price by more than 90%. During this year, the worst year for US Treasury returns in a century. Yeah, so these are the returns on the 3-month bonds, on the 2-year, and the 10-year. And we see here this plunge, right, in 2022. The plunge in the bond prices. But you see, they also increase. If you begin from here, they increase. The decline in bond prices was driven by surging interest rates with short-term treasuries. So when the interest rates are going higher, then people say, okay, I'm not interested in this bond that was issued 1 year ago because I can get now a bond with higher interest rates. And this causes these older bonds to depreciate in price, with short-term treasuries rising far longer than treasuries and the yield curve inverted toward the end of the year. The rise of US Treasury rates spilled over into the corporate bond market, causing corporate bond yields to rise, exacerbating. I see economists like this word, exacerbating. The pain corporate default spreads rose during the course of 2022. Corporate bond default increasing here. While default spreads rose across rating classes, the rise was much more pronounced for the lowest rating class, part of a bigger story about risk capital that spilled across markets and asset classes. After a decade of easy access translating into low-risk premiums and default spreads, accompanied by a surge in IPOs and startups funded by venture capital, risk capital moved to the sidelines in 2022. In sum, investors were shocked at the start of 2023, and there seemed to be little reason to expect the coming year to be any different. That pessimism was not restricted to market outlook. Inflation dominated the headlines, and there was widespread consensus among economists that a recession was imminent, with the only question being about how severe it would be and when it would start. Everyone were expecting a recession in 2023. The reverse has happened. The market and economy surprises the first half of 2023. Halfway to 2023, I think it is safe to say is that the markets have surprised investors and economists again. This year, the combination of high inflation and a recession that was on the bingo cards for some economists at the start of 2023 did not manifest, with inflation declining sooner than most expected during the year. This would probably end the inflation that is declining. It is true that a drop in inflation was anticipated by some economists, but most of them also expected the decline to come from a rapidly slowing economy, i.e., the recession and the Fed-driven that will not happen either, as employment numbers have stayed strong. Housing prices have, at least up to now, absorbed the blows from higher mortgage rates, and the economy has continued to grow. Economy activity. So we thought there would be a decline, but actually all this graph looks the same. You see, everything is backed in his articles by numbers. He actually extracts these numbers. As I know him, he actually goes to the source data, extracts the numbers, creates the graphs. I don't think he's copying things except for taking things from the Fed. It is true that the economic activity has leveled off and housing prices have declined a little relative to a year ago. But given the rise in rates in 2022, those changes are mild. If anything, the economy seems to have settled into a stable pattern, albeit at the high levels that it reached in the second half of 2021. I know that the game is not done, and the long-promised pain may still arrive in the second half of this year, but for the moment, at least, markets have found some respite. During the course of 2023, the Fed was at the center of most economic storylines, hero to some and villain to many others. With every utterance from Jerome Powell and other Fed officials passed for signals about future actions. Yeah, I remember this every time they talked, everyone trying to explain what they're saying to predict based on what they said. He said, he said this is not the last. He said with this increase, so there means there would not be another increase. Okay. That said, and it is worth noting that there is very little consequence in the economy or the market in 2023 that you can attribute to the Fed activity. The Fed has raised the Fed funds rates multiple times this year, but those rate increases have clearly done nothing to slow economy down, and inflation has stabilized, not because of the Fed, but in spite of it. I know that there are many who still like to believe that the Fed sets interest rates, but here is what markets interest rates from the US Treasury have done during 2023. Let's look at the 30-year. So the 3-month is the shortest bonds. We see the increase. 2-year also increase here. So there was some, yeah. And the longest one, the 30 years, pretty stable. If there is a Fed effect on interest rates, it's almost entirely on the very short end of the spectrum and not on longer-term rates. The 10-year and 30-year Treasury bonds rates have declined during the year. That does not surprise me, since I have never bought into the Fed did it, Tim, and have written multiple posts about why it is inflation and economic growth that drive interest rates and not central banks. This goes back to Lynn Alden as she talks about interest rates and whether we should increase them or not and who increases them. As inflation has dropped and the economy has kept its footing, the corporate bond market has benefited from default spreads declining as fears subside. As in 2022, the change in default spreads is greatest at the lowest rating, with the key difference being that the spreads are declining in 2023. Default spreads probably maybe across the different sectors. How safe are the bonds? Rather than increasing, though, the spreads still remain significantly higher than they were at the start of 2022. Stock markets perked up the first half of 2023. I noted that risk capital retreated from markets in 2022 with negative consequences for risky asset classes, to the extent that some of that risk capital is coming back into the market. Equity, so he's saying that some of the risk capital, the investors are coming back into the market. Equity markets have benefited, with benefits skewing more towards the companies and markets that were punished in the most in 2022. To understand the equity comeback in 2023, I started looking at the increase in market capitalization. So he's checking the comeback of the flow of money into the market. This can be an indication for him that the flow is changing back into the market in US dollar terms across the world in the first 6 months of the year, with a change in market capitalization 2022 to provide perspective. In US dollar terms, global equities have reclaimed 8.6 trillion in market value in the first 6 months of the year. But the severity of last year's decline has still left them 14 trillion below their values from the start of 2022. So there is an increase, but we cannot even compare, but it's half 2022. Looking across the regions, US equities have performed the best in the first 6 months of 2023, adding almost 14%, 5.6 trillion to the market capitalization, regaining almost half of the value lost in the last year rout. In US dollar terms, China was the worst performing region of the world, with equities values down 1% in the first 6 months of the 2023, adding to the 18% that was lost that year. Yeah, so China is the worst performing now, and the US is the best performing. The two best performing parts of the world in 2022, Africa and India, performed moderately well in the first, and we know what some people are claiming about the demography in China, that they don't have enough children to support the economy in the future. It's like a collapse. But let's see, I'm not sure about this. The first half of 2023 in US dollar terms, Latin America was flat in the first half of 2023. Though there were a couple of Latin American markets that delivered stellar returns in local currency terms, albeit with high inflation eating away at these returns, it is currency rate changes that explain that contrast between local currency and dollar returns. And in the graph below, I look at the US dollar performance broadly against other currencies, as well as against emerging markets currencies. This is a comparison of the currencies, mostly the same. Emerging in this orange, mostly the same, I think. After strengthening in the 2022, the US dollar has weakened against most currencies in 2023 a bit mildly. US equities 2023 into the weeds. The bulk of the surge in global equities in 2023 has come from the US stocks, but there are many investors in the US stocks who are looking at their portfolio performance this year and wondering why they don't seem to be sharing in the upside. In this section, I will start by looking with an overall assessment of the US equities level and equity risk premiums before delving into the details of the winners and losers of this year. Stocks and equity risk premium. I start my assessment of the US equities by looking at the performance of the S&P 500 and the Nasdaq during the first half of the year. As you can see, the S&P had a strong first half of 2023, increasing 15%. The Nasdaq has delivered almost twice that return with its tech focus. One reason for the rise in stock prices, at least in the aggregation, has been a doubling of worries of out-of-control inflation and a deep recession. So because there were a reduction in the number of people who think that there will be a recession, also the inflation has gone down, then the money is flowing back. And this drop in the fear can be seen in the equity risk premium, the price of risk in the equity market. In the figure below, I have graphed my estimate of expected return on stocks and implied equity risk and premium throughout 2022 in the first market. After a year for the record books in 2022, when the expected return on stocks, the cost of equity increased from 5% to 9%, the largest one-year increase in that number in history, we would have not just a more subdued year in 2023, but one where the expected return has come down to 8%. In the process, the implied equity risk premium, which peaked at 6% in January 2023, is back to 5% at the start of July 2023. Even after that drop, equity risk premium is still roughly the average value since 2008 and significantly higher than the average since 1960s. If the essence of bubble is that equity risk premiums become too low, the numbers, at least for the moment, don't seem to be signaling a bubble, unlike 1990 where the equity risk premium dropped to 2%. Sector and industry. The divergence between the S&P 500 and Nasdaq performance this year provides clues as to which sectors have benefited the most this year, as risk has receded. In the table below, I break all US equities into sectors and report on the performances in 2022 and the first half of 2023. As you can see, 4 of the 12 sectors have had negative returns in 2000, so not all sectors, of course, had an increase. 4 of them had a decrease. With energy stocks down more than 70% this year, the biggest winner, and this should come as no surprise, has been technology with a return of 43% in 2023 and also entirely recovering from its losses 2022. Financials handicapped by the bank runs at SVB First Republic have been flat for the year, as has been real estate, communication services and consumer discretionary have had a strong first half of 2023 but remain more than 20% below their levels at the start of 2022. Breaking sectors down into industry level details, we can identify the biggest winners and losers among industries. You see, this is becoming super complex. This is why for the normal person it's impossible to get into the details. Don't have the time. Better invest the time in your day job and just buy the S&P 500 or some global index. That's it. Just for this is just interesting. I read this because it's interesting. I mean, no one should invest based on these things. It's just too complex. You cannot do anything with it. He said in the beginning he cannot predict anything, right? But it's interesting to understand better what's happening in the markets. In the table below, I list the 10 worst performing and best performing industry groups based on purely on market capitalization change at the first half of 2023. The worst performing industry groups are in financial services and energy, with oilfield services company being the worst impacted. The best performing industry group is auto and truck. With those results are skewed upward, one big winner, Tesla, accounting for a large portion of the increase in the market capitalization in this sector. There are several technology groups that are on the winner list, not just in terms of percentage increases, but also in absolute value changes, with semiconductors, computers, peripherals, and software all adding more than $1 trillion in market capitalization apiece. Market capitalization and profitability. In the first 6 months of the year, we have also seen concentrated gains in larger companies, and this can be seen in the table below, where I break companies down based upon their market capitalization at the start of 2023 into declines, and then break stocks into each of the declines in money-making and money-losing companies based upon the income 2022. Again, the numbers tell a story. With the money-making companies at the largest market cap decline accounting for most of the gain in the market cap in the US equities, the market capitalization of these large money-making companies increased by $5.3 trillion in the first 6 months 2023. 97 of the $5 trillion increase in value in the US equities. Value and growth. Over the last decade, I have written many posts about how all-time value investing, with its focused low PE and low price to book stocks, has lagged growth investing. So the value investing is like the Buffett investing, where you find company that are earning good earnings and don't have much less expenses, so the PE value is low. You invest in them. But what he's saying is that if you invest like this, then you lose the growth companies, because those growth companies, they won't have a good ratio, because they are still growing, they are investing, they don't have much income. with high growth stocks that trade higher multiples of earnings and book value, delivering much higher returns than all-time value stocks, low P ratios, high dividend yields. In 2022, all-time value investors felt vindicated as the damage that year was inflicted on the highest growth companies, especially in technology. That celebration has not lasted long, though. Since 2023, we saw a return to a familiar pattern from the last decade, with the highest price to book stocks earning significantly higher returns than the stock with the lowest price. As you can see from the chart, almost all value increase in the US equities has come from the top 2 decades of stock. In terms of price, this is again the thing we cannot predict who will perform better. In terms of price to book ratios, looking at the value and growth go back and forth between the winning and the losing columns in 2023, I believe that this is a pattern that will continue to play out for the rest of the decade with no decisive winner. An assessment. I know that one of the critiques of this market rise is that it has been uneven, but almost all market recoveries are uneven, with some grouping of companies always doing better than others. That said, there is a lesson to be learned from looking at the winners and the losers in the first half of 2023 markets sweepstake. Big tech. There is no doubt that this market has been largely elevated, not just by tech company, but also a subset of large tech companies, 7 companies, Apple, Microsoft, Nvidia, Amazon, Tesla, Meta, and Alphabet, have seen their collective market capitalization increase by $4 trillion in the first half of 2023, accounting for almost 80% of the overall increase in equity values at all 6,669 publicly traded US equities. If these stocks level off or drop, the market will have trouble finding a substitute to keep the market pushing higher, simply because of the size of the hole that will need to be filled with a profitability skew. While this does seem like the reversion to the tech boom that drove markets prior to 2022, the market seems to be more inclined to rewarding money-making tech companies at the expense of money losers. If risk capital is coming back in 2023, it is being more selective about where it is directing its money, and it is therefore not surprising that IPOs, venture capital, and high-yield bonds insurance have remained mired in 2022 low levels. And an economic twist, one reason that these big and money-making tech companies may be seeing the return of the investors' money is that they have navigated the inflation storm relatively unscented, and some have emerged more disciplined. From the experience, the 2 best cases point are Meta and Google, both of which have not only reduced payrolls but also seem to have shifted the narrative from relentless pursuit of growth to one of profitability. It is true that as the market rallies lengthen, they draw in more stocks into their orbit, and it is possible that the market rally will broaden over the course of this year. That said, this has been a decade of unpredictability, starting with the first quarter of 2020, where COVID ravaged stocks, and I don't think market makes much sense to take charts from 2008, 2001 or earlier and extrapolating from those. The rest of the year, what's coming? The market mood is buoyant, as investors seem to be convinced that we have dodged the bullet with inflation cooling and soft landing for the economy. The lesson that I have learned, not just from the past 6 months of 2023, but from the market performance over the last 3 years, has been that macro forecasting is pointless, and that trying to time the markets is foolhardy. If I were to guess about what the rest of the year will bring, here are my thoughts. On inflation. Yes, this is bewildering. It's just said that it's impossible to predict the market, and now we're guessing. Okay, so he uses the word guess about what will happen. On inflation, the good news is the inflation is in the first half of the year should not obscure the reality that the inflation rate 3% in June still remains higher than the Fed targeted value of 2%. That last stretch, getting inflation down to 3% to below 2%, will be a transform for and we will be exposed to macro shocks from energy prices or regional unrest that can create inflationary shocks. On the economy, notwithstanding good employment numbers, there are signs that the economy is cooling, and it is again entirely possible that this turn into a slow motion recession as real estate, especially commercial, succumbs to higher interest rates and consumers start retrenching. On interest rates, I do think that hoping and praying that rates will go back to 2% or lower is a pipe dream. As long as inflation stays 3% or higher, in short, with or without Fed. Long-term treasury rates have found a steady state of 3.5 to 4%, and companies and investors will have to learn to live with those rates. I have never attached much significance to the yield curve inversion as a predictor of economic growth, but that inversion is unlikely to go away soon, as near-term inflation remains higher than long-term expectations. On equities, the one certainty is that there will be uncertainties, and it is unlikely that the market will repeat its success in the second half of 2023. I did value the SP 500 at the start of the year and argue that it was close to fairly valued then, updating this valuation to reflect updated perspectives on both dimensions as well as an index price that is about 16 higher. Here's what I see. Now that I have used analyst projections and earnings of the index from 2023 to 25 and adjusted the cash payout over time to reflect a reinvestment needed to sustain growth long term. After the run-up in stocks prices in the first 6 months, stocks looks fairly valued. So saying stocks now looks fairly valued. Given estimated earnings and cash flows, and assuming that long-term rates have found their steady states, unlike market strategies who provide target level for the index and intrinsic value delivers the value for the index today. To get an estimate of what translates into as a target level of the index, you can apply the cost of equity as the expected return factor to get index levels in future time periods. It goes without saying, but I will say it in any way, that the economy may still go into recession. Analysts may be overestimating earnings and inflation may make a comeback, pushing long-term rates. If you have concerns on these fronts, your investing should reflect those worries, but your returns will be only as good as your macro forecasting abilities. Mine are not that good, and this is why I steer away from grandiose statements about equities being in a bubble or bargain. While uncertainties abound, there is one thing I am certain about. I will be wrong on almost every single one of these forecasts, and there is little that I can or want to do about it. This is why I demand an equity risk premium in the first place. And all I can do is hope that it's large enough to cover those uncertainties. Time of humility. If the greatest sin in investing is arrogance, markets exist to bring us back to earth and teach us humility. By this sentence, I understand he loves this topic. The first half of 2023 was a reminder that no matter who you are as an analyst and how well thought through your investment thesis is, the market has other plans. As you listen to market gurus spin tales about markets, sometimes based upon historical data and comparing charts, it is worth remembering that forecasting where the entire market is going is by itself an act of hubris. In the spirit of humility, I would suggest that if you were a winner in the first half of this year, recognize that much of that can be attributed to luck. And what the market gives, it can take away. By the same token, if you were a loser over the course of the last 6 months, regret should not lead you to try to load up on the winners over this period. That ship has sailed, and who knows? Super important section. Your loser portfolio may be well positioned to take advantage of whatever is coming in the next 6 months. So what he's saying is, we saw that the big tech has won this first half years. We saw that energy has lost. So someone who is invested in energy might think, okay, I need to go to big tech, but we have no idea what will happen. Okay, and this is some links to the spreadsheets. Again, amazing blog. Also, you can see him talking about this in his YouTube channel. In addition, I just think you also go through the text. Okay, so what you saw me doing, he's also doing, and he wrote this.